Now, you might call it Wall Street's Magic Act. 2 years after the credit markets seized up, banks are now sorting through the structured finance securities and finding ways to repackage them with top credit ratings to boot. So who wants these investments and what do the regulators think? Well, Bloomberg's John Ehrlichman has that story for us. John?
Hey, Scarlett. Well, on Wednesday, Bloomberg reported on Morgan Stanley's plan to take downgraded collateralized debt obligations, or CDOs, and turn them into new securities with AAA credit ratings. The plan, Morgan Stanley will split the debt into 2 tranches, and one of them, made up of $87 million in securities, is expected to get a AAA rating. How is that possible in this environment? Well, we know Wall Street firms and institutional investors are sitting on a mountain of illiquid paper, from CDOs to CMBS. Structured product teams at these firms sort through the paper, then take the appealing tranches and turn them into new products with a higher credit rating. It certainly sounds familiar, but for firms, it's a chance to reduce exposure to this space, not to mention generate fees by selling these to, say, distressed debt investors.
These new securities are actually colloquially being called kitchen sink bonds. They're taking the best of what can be repackaged and re-rated by essentially S&P and Moody's and Fitch, and they're being resold as a way of moving them off of folks' balance sheets.
Former SEC Chairman Harvey Pitt tells Bloomberg the repackaging points to the unfortunate failure to put in place critical regulatory reforms to prevent the next crisis. Meanwhile, James Gellert of bond rating agency Rapid Ratings says current SEC Chair Mary Shapiro is actively looking at Wall Street's relationship with the agencies who provide those AAA ratings.
For the SEC to actually fundamentally change the way the entire symbiotic relationship of issuers, the traditional rating agencies, and the Wall Street houses work together is extremely difficult, and there are a lot of powerful lobbying forces behind that.
In the meantime, Scarlett, don't be surprised to see more of these deals. For example, Bloomberg has learned Goldman Sachs is preparing to sell $217 million worth of repackaged commercial mortgage debt. Back to you.
Thanks very much, John Ehrlichman.